Well, good afternoon, and I hear rustling in the background. Let me go ahead and first of all bring this over to Russell's slides, and I'd like to welcome everyone this afternoon, and thank you for joining us as we take a look at understanding implied volatility. Now, with us today, I'm very pleased to have Russell Rhoads, who is an instructor, a senior instructor with the Options Institute. It's the educational arm of the Chicago Board of Options Exchange. He's also an author of Spread Trading, a comprehensive guide to strategies and tactics, as well as trading VIX derivatives. So I also did want to let you know that Russell has been with the Options Institute since 2008 and is also, besides being a financial author and editor, he instructs a graduate level options course at the University of Illinois in Chicago. So I'd like you all to join me in welcoming Russell here today. So Russell, I'm going to not waste any further time and just move the ball over to you so that we can get started. Thanks for joining us, Russell.
All right, thanks for the nice introduction as always, Cynthia. As Cynthia said, my name is Russell Rhoads. I'm an instructor here, or senior instructor here at the Options Institute. And each of us here has a different area that they tend to focus on. There are actually 4 instructors here at the Options Institute. And if you've thought of us, and I've actually had college professors say that it's kind of like I'm a college professor that works for an exchange. And when you have professors, they all have areas of interest and areas of focus. My area of focus really has been implied volatility. I actually, I like to spend a lot of time. In fact, I'm going to do this course here with you guys for about an hour, and then I'm actually spending 2 hours with a group from the China Financial Futures Exchange going over the basics of implied volatility as well. And then this evening, I'm doing a lecture at a university on VIX and what college students need to know about VIX. So as my wife has said in the past, if implied volatility were a woman, I would probably marry it. It is a big area of interest for me. Today I'm really going to talk about the nature of implied volatility, how it behaves for different instruments. Implied volatility is not the same for different types of option contracts. A lot of people are under this impression that if a stock goes down, the implied volatility for the underlying options is going to go up, and they get that impression because that is how VIX behaves relative to the underlying, which is the S&P 500. Before we dive into implied volatility, I'll do a quick, and I promise it will be a very quick, review of option pricing factors, just so we're all thinking about the Greeks. And I'll focus on Vega for just a couple of minutes, and then these last 3 bullet points are the ones that I will spend the majority of time on. Don't think that half the course is this top half and half of what I'm going to talk about today is the bottom half. It's more like we're going to rush through these 3 bullet points, and then we're going to slow down for the other bullet points. We've had quite a turnout today, so I will do my best to answer questions if they're relevant to what I'm speaking on. If you throw a question out there about implied vol and I skip over it, I will backtrack and get to every question between now and the top of the next hour. And there's one right there on VXX and VIX. I will get to that one at the very end, I promise. But that one is not going to talk too much about VXX today until we get to the Q&A. But I do have a strong opinion on that one. The option pricing factors, here they are. Underlying market price, option strike price, timed expiration, dividends, and interest rates, which are the time value of money, and then implied volatility. You put these different figures into an option pricing calculator, and what you will get out is a theoretical value for an option contract. 3 of these factors change over time. Now, I know interest rates may change, but we usually have a good idea of a change in interest rates. We've had a good idea that interest rates are not going to change for a long time now. The underlying market price will move around on an underlying stock or ETF that's based on a commodity. I'm actually going to talk about some of those today, or an index. The other factor that moves around, and it's a little bit, it is by far the most difficult of all the topic of all the pricing factors to get a handle on here. So implied volatility is the one that you definitely will not necessarily see how it moves around, but I'll try to demonstrate that. And the question that I just got about interest rate derivatives, we don't trade interest rate derivatives at the CBOE, so that's not a topic that we're going to cover today. So pricing calculator, these are the inputs that you might put in, and you will get a theoretical price for a call or a theoretical price for a put. However, that's not how we get the implied volatility. The implied volatility actually comes from the flow of trading that comes into the floor. That's okay. All right. Now I'm getting a question about interest rates. Interest rate options and interest rate input, they're two completely different topics. Interest rate derivatives are options and futures on interest rates. The interest rate input on the calculator is basically the risk-free interest rate, and that's what we've been using around 1% for some time now. But back to where do we get that implied volatility number from? We get it from the call price. Buying and selling will come into the floor, and the option prices may change based on the order flow that the individual market makers are seeing. And you take that price and you back into the Black-Scholes formula, and you get what the market rate of implied volatility is. It's just a reversal, just changing the formula around a little bit to get a volatility output. And implied volatility, as I just stated, it's basically determined by the market price of an option contract. Let's see. The bell curve is basically what implied volatility is telling you. As I say, you never get away from it. From any of us that studied finance in school, I teach a risk management class and a derivatives class right now. Just about every week I'm pulling up a bell curve for one reason or another. What implied volatility is actually telling us, it is telling us with some sort of prediction where the market thinks a stock price is going to be one day down the road, or the easiest way to visualize it is at expiration. You can actually adjust that projected range based on a different time periods. The most basic way to take a look at this is implied volatility is actually an annualized number. So let's say XYZ is trading at 100, and we've got a put 1 year. We've got an option that expires 1 year from this very moment, and the call and put implied volatility turns out to be 20%. Well, what that option is basically telling us is that with 68.2% certainty, the market thinks XYZ is going to close between 80 and 120 a year down the road. Now we can actually adjust that for, that's a 1 standard deviation range. Up 1 standard deviation is up 20 points, down 1 standard deviation is down 20 points. We can actually take that a little bit farther and say the market is pricing with 95.4% certainty. We're going to be between 60 and 140. That's a 2 standard deviation move. And 99.7% certain, not that you can really do anything trading-wise with this information, but statistically, the market is pricing with 99.7% certainty that we're going to be between 40 and 160 a year down the road. Well, this is what implied volatility is telling us. You can actually take implied volatility and de-annualize that number. In fact, a lot of traders have a 1-day rule of thumb where they actually will divide implied volatility by the number 16. There are 2 ways to go about converting implied volatility. You can either use the number of calendar days or the number of trading days. And on average, we have about 252 trading days in a year. We've had 251 and 253 over the last 10 years. I know that because my intern asked for something to do, and I said, go count the trading days. So, yeah, if you're an intern of mine, don't ask what to do. I'll give you something mundane like that. When you convert implied volatility, you can use the square root of the number of calendar days until expiration divided by the number of calendar days in a year, or the number of trading days divided by the number of trading days. And if you notice, I changed that very quickly, but we've got $5.01 or $5.05. When you're talking about a long period of time until expiration, you can really use either trading days or calendar days. You tend to get just about the same answer. Now, when you get close to expiration, like 3 days to expiration, which you know, every week we now have options expiring at the end of the week. So we'll have, you know, we frequently have options that just have a few days left to expiration. I find that you're better off using trading days at that point. In fact, one of the other instructors here, the most senior of instructors here at the Options Institute, wrote a book a while back, and he created his own option pricing software. And when you get within 7 days to expiration, it actually changes the denominator from 365 to 252 on the software that he has to convert implied volatility to a shorter time period. So what implied volatility does not tell us, and this is one of those interesting pieces of information, and one of those things that I think all traders that are doing short-term trades or even longer-term trades with option contracts should be aware of. The implied vol does not take into account how a stock gets from point A to point B. Think back to that first example I gave you where a stock was trading at 100 and the market was pricing in a year down the road that we were going to be between 80 and 120 a year from the day. Well, that's not taking into account whether the stock is going to trade below 80 or trade above 120 over the next year. It's only projecting forward where the stock's going to be, or where the market thinks the stock will be in a year. And we ran some back tests. I actually created a Monte Carlo simulation using MATLAB a while back to replicate random stock price movements. Now, the random stock price movements are based on a bell curve of movements, but that's also, you know, how we project forward using implied volatility. I am well aware that there's actually an asymmetric path that most stocks take, but just using a Monte Carlo simulator to determine, you know, random stock price movements based on a bell curve or based on a normal distribution, we actually ended up with some pretty interesting results based on what we came up with. The MATLAB, we would run 1 million simulations. We used a wide variety of pricing and volatility and timed expiration inputs, but the output actually was consistently the same. Now, the example that I like to use is stock trading at 100 with implied volatility of 30% and an option expiring 30 trading days out. If you ever see me do one of the multiple presentations I do on implied volatility or any other kind of systematic quantitative trading with options, I always use trading days just to get the holidays out of there. This was the parameters that we decided to settle on. Again, if I change the stock price, if I change the implied volatility or change the number of trading days, changing those parameters does not change the results at all. So this is a really interesting outcome that we got. So again, statistically, we know that, that the market, assuming the market is correct, and we know the market's not always correct, but assuming the pricing of the market is correct, stocks should close within up or down 1 standard deviation 68.2% of the time in the future. And we ran a Monte Carlo simulator and determined how often does a stock close outside of 1 standard deviation at some point over the 30-day period, which means that it's very possible that the stock could close one day outside of up 1 standard deviation or down 1 standard deviation, but still close within up and down 1 standard deviation at the end of the 30-day period. And despite knowing that, or assuming that the market is correct, that 68.2% of the time we're going to land between up and down 1 standard deviation, over half the time up or down 1 standard deviation is violated over the life of the option contract. So if you project this onto some sort of trade, and the most common trade to project this onto would possibly be an iron condor. If you project this onto an iron condor, where up or down 1 standard deviation results in a possible loss in the trade, over half the time over the life of the trade, you're actually going to reach, and I can come up with all kinds of fun academic terms, but you're going to reach what you might refer to as a point of discomfort, or a point where you start to be concerned about the trade, even though almost 2/3 of the time you expect the market to land in a certain place. Over half the time, the trade is going to provide you with some sort of concern, and that's statistically knowing. And statistics can tell us everything that we need to know about a trade. I've been quantitatively trading for well over a decade, but we always can go through those emotional, I know this is how it's supposed to work. Maybe this is the time that it is not working out. So with that, just what implied volatility is not saying, it's just not telling us what the path is. Implied volatility can be projected out. After an earnings or another corporate announcement, stock's going to react, and implied volatility from earlier on might not match up to what happens with the underlying stock. Now, what I really want to focus in on a little bit more and then start fielding some questions is the behavior of implied volatility. Because of the popularity of VIX and the interest that VIX has gotten in the marketplace, a lot of market watchers, or let's even call it some of the talking heads, are under an assumption that when a market drops, the implied volatility goes up. This could not be further from the truth. Not all, I should have made this one, I'm going to underline this one. This should be the biggest theme of the day here. Not all implied volatility is the same, and that's an understatement. I continue to, as we come up with more volatility indexes here at the CBOE, I continue to run in more and more studies and notice how different markets react to either anticipate or react to price changes in the underlying. Now, I think everybody at one time or another, if you've taken a look at VIX, if you've heard me talk about VIX, or seen a chart on VIX, this is what typically a chart of VIX looks like relative to the S&P 500. Bottom chart here is VIX. Every time we get somewhat of a sell-off in the S&P 500, we tend to see a little bit of a spike in VIX. And then shortly after that sell-off, VIX tends to top out. Today's a great example of that. We had somewhat of a sell-off in the market yesterday. VIX spiked up. The market seems to be fairly strong last I checked, and VIX has come back down. That's been the consistent pattern this year for VIX, but that's actually been the consistent pattern for VIX over the life of volatility. In fact, we can look back a little bit farther, and VIX versus the S&P 500, and this says weekly. That should say 2000, because that's a weekly chart going all the way back to 2000, and you can see every spike in VIX actually reverts down to some sort of a reverts back down over time. And that's actually another piece of information about VIX that I'm going to get to shortly. But keep in mind, any type of implied volatility, I don't care what market you're talking about, there's always a reversion to some sort of mean of implied volatility over time. And I will touch on that. There's a chart that comes up that really demonstrates that, but that's one of those major points about implied volatility I definitely want to get across today. This shows the inverse relationship. The S&P 500 VIX correlation, and I'm using that sort of equals to, it doesn't matter over what time period you look at. Generally, the correlation of VIX to the S&P 500 is about -0.75. And just to respond to the very first question that got thrown out there, the S&P 500 to VXX correlation is about -0.8. So you were asking about is VXX is VXX a good method to get long volatility? It has that same inverse relationship, but I'll touch on that a little bit more. I just wanted to remember that number while I had this slide up in front of me. You can see on a pretty consistent basis, the S&P 500 and VIX, when the S&P 500 is higher, VIX moves lower. When the S&P 500 is lower, VIX moves higher. With one exception here in 2008, when we had 2008 can be an exception for a lot of reasons, but for one exception here in 2008, for the most part, it's usually very close to 80% of the time, which means 4 out of 5 days you expect the S&P 500 and VIX to move in the opposite direction. Very often when they move in the same direction, you will hear some market forecasters try to make a big deal out of that. Sometimes I think there's some meaning in that. Sometimes I think it's just market noise. But keep in mind that 1 out of 5 days, once a week, we would actually expect VIX and S&P 500 to move in the same direction. But over the long term, either on a daily or even a weekly basis, going back to any extended time period beginning in 2000, the correlation is about a minus 0.75. This is a really interesting chart that just shows what happens with the implied volatility of options on the S&P 500 when we get a big sell-off in the S&P 500. The S&P 500, the biggest sell-off that we've had since January 2000, 9% sell-off. VIX spiked up 25.16%. In fact, the 10 worst days in the S&P 500, all but one of the 10 worst days do we have a bigger move to the upside for VIX than a move to the downside for the S&P 500. And if I extended this out to the 50 worst days for the S&P 500, all but one would have VIX moving up more than the S&P 500 moved down. The point behind the previous chart, and I'm actually going to go back to the previous chart and answer Andrew's question, but the point is that implied volatility for indexes, and this is not just, I know there are people from multiple countries on, this is not just for the S&P 500 versus VIX. Any published implied volatility index that is based on a broad-based market index has a very similar relationship. I'm working on a blog that's going to go up tonight where I talk about the V stocks, the TSX 60 VIX, and the S&P 500 versus VIX, and the Australian VIX. Getting ready to start trading futures on the Aussie VIX. So I'm putting a blog up this evening where I'm going to talk about how consistent the inverse relationship is between the S&P 500 and the VIX and all those other broad-based indexes. Andrew was asking about the first column. I'm assuming you meant the first column on the slide that I backed up to. I think that the market it tends to drift higher more. The thing is, we will have instances, and I think you're asking why is the percent just a little bit higher on this one than the second column here. My thought behind that, and I've actually given it some thought because it's been like this for some time, I think what happens is the market trades up and VIX just continues to trend lower. I think if we have a slight down day in the S&P 500, but we're in an uptrend, and we are in an uptrend more often than we are in a downtrend, I think that you're more likely to see VIX move up or VIX move down a little bit, even if we just have a small down day in the S&P 500. I probably should do a little bit more work on the magnitude of that and see if that holds up. But that's been my feeling, and that's what I've noted in the past as far as the S&P 500 and VIX moving in opposite directions. Also, there's actually, and this is, I probably should have 3 slides to fully explain this, but there's actually a day of week issue with Fridays where VIX is actually under just a little bit more pressure. So on a Friday, it's very possible with the S&P 500 down just a little bit for VIX to be under pressure as well, and it just has to do with implied volatility adjusting for the weekend. Domenico was asking, how does the inverse relationship hold up on an inverse relationship and on an intraday basis? And I can tell you very, very well. And in fact, watching VIX relative to the S&P 500, there are times if the S&P 500 is selling off and continues to sell off and VIX is not making new highs, that can be a good intraday signal that maybe that you might want to consider getting long the S&P 500. I've done some testing on that. I should do more testing on that, but I have noted that and profitably noted that in the past as well. And the correlation, the minus 0.75, that is direction and magnitude. This correlation takes into account the percent change of the VIX on a daily basis and the percent change for the S&P 500 on a daily basis. So it is direction and magnitude. That's why it's a little bit less than these two opposite numbers here. So great question there. Just one last thing about VIX and how it reacts. Also why people like to maybe take a look at buying VIX calls when they're worried about the S&P 500 selling off. I'm doing this distribution of VIX returns from January 2007, which is about when trading on VIX derivatives really did start to gain some traction, through August 2013, and we actually have 74 15% moves since 2007, which I consider fairly significant moves to the upside. That number has increased because yesterday we actually had a 16% move. But also note that after talking about the bell curve at the beginning of this presentation, this is not a normal bell curve at all. It actually, I could probably do a better job drawing it out, but it's definitely got a fat tail, but a fat tail to the upside. And one of the questions I get very frequently, I'm surprised I haven't gotten it, is why the inverse relationship? And the reason the inverse relationship exists has to do with the nature of SPX option trading. More puts on an average day trade than calls. This is the SPX put-call ratio. When the number is above 1, which is just about all the time, that means we are trading more puts here at the S&P in the S&P 500 pit at CBOE than we're trading calls. Well, this is the only market where we consistently trade more puts than calls. And that is because the most common use of S&P 500 index options is as a hedging vehicle by portfolio managers. And I almost wish I could throw this video up, but I make the assumption that everybody at one time or another has had insomnia and come across trading places, and they've seen Eddie Murphy in the back of the limo saying, they're panicking. I can feel it, they're panicking. Don't buy the pork bellies yet. Well, when they're panicking, like yesterday actually, we will see an abundance of aggressive buying of S&P 500 put options. That purchasing of put options pushes the implied volatility up, pushes the implied volatility higher, and it pushes the implied volatility because of increased demand for SPX put options. That is why we get that reactionary spike in volatility that occurs when the S&P 500 sells off. Thomas just asked, what's the formula for computing implied volatility? It's you basically move the inputs to the Black-Scholes formula around, and the output is implied volatility based on the price of the option contracts. So it's basically a modification of the Black-Scholes formula. This is the reason that we have that inverse relationship. And then finally, implied volatility, and this occurs in every market. And this theme actually came up at our European Risk Management Conference a couple of weeks ago, the mean reverting behavior of implied volatility. And these are professional volatility traders from all over the world talking about how they handle trading implied volatility. And generally, over time, implied volatility is actually, oscillates around some sort of a mean, and These are the two things that we know about VIX. A move up in VIX is usually followed by a drop. These days it's been pretty quickly, and this is the more difficult one to try and time. A long period of complacency is usually going to be followed at some point by a spike. I guess we're finally getting our 2013 spikes over the near term here, or just over the past couple of weeks. There is VIX versus a 10-day moving average. Actually, I also have the same chart using VIX futures, using a weighted VIX future, and the chart looks almost exactly the same. I did a meeting once with an advertising firm to talk about VIX so they could try to get a better handle on how people trade it, and one of the questions that came up in the meeting, and these are not trading-oriented people, was what makes you get up in the morning and think about buying VIX? And my response was actually nothing. But if I wake up in the morning and CNBC is reporting that the S&P 500 futures are off 15 or 20 points, and it looks like VIX is going to spike up, I'd be thinking about taking some sort of position, whether it be in VIX options, VIX futures, or a lot of questions about VXX keep popping up, or VXX. I'd be thinking about taking a short position in related to one of those instruments, with the knowledge that in time, these sort of spikes are going to revert back to a mean. Sometimes I say that and I don't have a chart, and somebody says, well, what's the mean? Well, it moves, and you can see here with the 10-day moving average, it moves around. But implied volatility, by its nature, and this is on every type of instrument, is a mean reverting instrument. Keep that in mind. Now, equity volatility, equity implied vol is a forward-looking measure, and it's more forward-looking than the implied volatility on index options or certain types of exchange-traded products as well. Implied volatility is definitely forward-looking with respect to stocks, and we've got 5 stocks at the CBOE that we actually calculate implied volatility indexes on. And you can see the correlation is negative, and that actually has to do somewhat with the market influence. Notice this is from June 2010 to August of 2013. We actually have a high negative correlation between VIX and the S&P 500 over that period of time. And you can see that they do move opposite, but not nearly to the extent that they move opposite, that the VIX moves opposite to the S&P 500. Can somebody let me know that I am being heard? I just got one person saying no sound, so I get a yes from somebody. Thank you. There's enough. All right. Thank you, everybody. Just wanted to make sure I wasn't talking to myself. I do that enough. So comparison with the VIX. Just want everybody to know implied volatility, equity volatility is forward-looking, and this is a great chart. And this is a great chart from a service that I'm not associated with. iVolatility.com. There's the website right there. I'm putting my red dot underneath the name of the website. iVolatility.com does a great job of depicting implied volatility on a wide, just about anything that, anything that has an active option market on it, you can get an implied volatility chart. The amber line actually represents the implied volatility. The blue line represents the historical volatility. I wish I could erase that one off somewhere, because the really important line is the amber line. And I love this Google chart. Google is by far the easiest academic example here. Big sell-offs and implied volatility right after earnings. We trade up and level off, and you can see right about here, if we had gone off the chart to, whoops, I'm all about drawing today. If we'd gone to about here, you would have seen another sell-off, because that was about where the next earnings report comes out. Very timely, because Google reports their earnings tomorrow, I believe, and you'll probably see the same sort of volatility crush occur. This is very common among equities. It is different for different stocks. Every stock has its own trading behavior. and the implied volatility for every stock behaves differently. You can go to ivolatility.com and you can, you can definitely take a look at how things behave differently. It's also a good, if you're thinking about doing a short-term trade around earnings, you can get an idea of what sort of change in implied volatility what sort of change in implied volatility you'd expect. Yaroslav was just asking about the 6E futures. We don't trade those at the CBOE, so I really don't know where you can get. You could try the CME's website. I'm sure they would have. They've got lots of great tools on their websites, so you can you can definitely check there for the volatility. Wow, lots of people continue to lose audio on me. Cynthia, if you're close by, and I see you close by, is there anything we can tell everybody, or?
Well, what's happening is a conflict on each individual machine, so what I am doing is sending notes to those who lose audio privately, so with some instructions. But for those of you who may have intermittent audio, simply close your email down. That's usually what's causing it. But let's continue because
I just wanted to make sure that people didn't think I was ignoring them.
No,
you're in Cynthia's good hands.
I'm not ignoring them either, but I do want to remind everyone, if you do happen to lose audio, we are recording today's event, so you'll actually get a link later on this afternoon, so you won't miss the information, but easier to close email down and prevent it from happening in the first place. So back to you, Russell.
Arturo, before I move on to non-equity market volatility, how can you use implied volatility to trade stocks? You know, one of the nice things that you can use implied volatility to trade stocks is you can get an idea of what sort of price magnitude movements are being priced in by the option market. In fact, you can get an idea if how much risk is in a stock leading up to an earnings release. And then what you can also do is you can take a look at what a stock has done relative to past earnings releases. And this is going to be a very shameless promotional type of thing, but I'm actually going to type this into all participants. I do a blog on weekly options at this website, and the CBOE blogs website, and I actually talk about the magnitude of how much people were expecting stock, or how much stocks have moved in the past, and then you can take a look at what implied volatility is pricing in and get an idea as to whether or not earnings are being overpriced or underpriced. But I did a weekly's preview, and I only did it on the 30 stocks that we have weeklies on that report this week, and it gives you an idea of what has happened in the past, but also what is the market expecting in this next earnings release. So you can't necessarily get implied volatility to give you an idea of whether the market's expecting a stock to move higher or lower, but you can use it to get an idea of the magnitude of price movements. Paul's asking the Google pre-earnings volatility, how justified were the implied volatilities relative to the subsequent move in the underlying? I think we're running on 13 of the last 14 where the implied volatility priced the move in Google within $1 or so. It's actually been fairly accurate. I have to take that incident about a year and a half ago where Google released their earnings early by accident out of that equation. So, but otherwise, it actually implied volatility, especially for Google. It's actually why I use it. Is actually a pretty darn good predictor of how much a stock is going to move on earnings. The link, actually, that is the correct link, so try it again and see if that gets you to the blog site. All right, real quick on the behavior of implied volatility for non-equity markets. Different markets react differently. My favorite one to talk about, and one that's given us a lot of fun to look at this year, is the gold market. We have a gold volatility index here at CBOE. It's quoted under the symbol GVZ, and GVZ has done some interesting things in the past. It actually shows you, this is GVZ this year. This has been the relationship to the market this year. You can see we've had some sell-offs in GLD and we've had some spikes in GVZ. However, in the past, and this is where it gets kind of fun, the range, the percent, this should be a percent range, but the percent range for gold, the gold high to the gold low, it's kind of matched up somewhat with how much GVZ has moved around. But the really significant table that I want to take a look at, we're getting lots of questions, so I want to get through gold and then get to the questions. Gold versus GVZ, and we only have 6 months for 2008, and this is through August of 2013. Look at the correlation. Some years it's positively correlated, and sometimes it is negatively correlated. It just depends on what type of market we're in. And the thing is that sometimes gold will spike up to the upside, and you will actually see a rush to buy call options. And this is because some consumers of gold basically will need to hedge against higher gold prices, and some producers of gold will have to hedge against lower prices. So sometimes, like this year, you've seen a rush to buy put options on GLD when the GLD has sold off, and the result has been a spike in GVZ. So, and the silver market looks a lot like this. The oil market looks somewhat like this. And you just have to think about the markets where individuals will need to will actually need to hedge both to the upside or to the downside. Typically, investment managers are more concerned with hedging against a downside move than an upside move. Not across the board, but it's pretty typical. So, equity index markets are very reactionary. Individual stocks, the implied volatility varies from stock to stock. Outside of the equity-related markets, different markets have a variety of implied volatility activity. It's not just like the VIX S&P 500. I got a private question from Earl asking for me to comment on autocorrelation between equity prices and implied volatility. I'm not sure if you could elaborate on that, that would help me. I just want you to think that I'm not ignoring the question. I'm going to start working back on questions. When VIX spikes, it is always a go. I'm going to put, there's my contact information. If you're watching a recording or have a follow-up question, or I miss your question, I'm going to do my best, but there are a lot of them out there. When VIX spikes, is it always good to play shorting out of the money puts? Actually, I would be going the other direction on that. But when the VIX spikes, I would actually think about putting on a short position where I would think about maybe selling calls, but I would buy a higher strike call because we have had instances where one VIX spike is followed by another. Being naked short volatility is just a risk that I personally don't like to take. I see somebody put the updated CBOE Options Hub link. Thank you very much. I always mistype that one, so I like the older link. Pooja was asking, how do you do that? You can give an example. I think that was related to earnings. Take a look at that blog and take a look at take a look at what Google does after they report and what the options were pricing in. Take a look at the at-the-money straddle on the close on Thursday and see how well that priced in the Google earnings report. One of the nice things about Google is going back even before we had weeklies, Google tended to report their earnings on the Thursday afternoon before Friday expiration. So you had one-day options, and it was real easy to see if the options had priced in the move. Let's see, Arturo asked that great question about using implied volatility. It's more about magnitude than direction. You will get a recording of the presentation. I think Cynthia will send something out. I'm curious how to find. I saw the question about the S&P 5. The futures implied volatility, historical volatility chart. I'm kind of curious about that myself. I can tell you that upon second thought, I automatically directed you to the CME. I know that there is a strong correlation between the implied volatility of SPY options and the implied volatility of SPX options. And that's because they basically have the same underlying. I've not looked at this, but I would not be surprised if the implied volatility of options on the any of the futures markets are very similar to the indexes that we have. And you were actually asking about, I think, the euro currency futures. Well, we actually have an index. I'm going to double check the ticker before I give it out, but I believe it is. That's it. EVZ. And I'll type that because it doesn't sound very. EVZ. That is the euro currency ETF index, volatility index. So that might actually relate well to the euro currency trading as well. Okay, VXX. I'm going to give my opinion on VXX. Thomas is asking, what are the main components of the Black-Scholes equation? Well, I gave that at the very beginning, and I'll go back to that slide, but that was at the very beginning of this presentation. It's right there. It's those pricing factors. This is the pricing calculator, and to determine, it's not a price, it's the percentage of implied volatility. There are your inputs, and you would get a volatility output. So that is that is basically how you determine implied volatility. So, and that's the second time that we've run through that. So let's see, keep going backwards. Okay, VXX. I've actually run different. Actually have different opinions about VXX coming from a lot of different people. Here's what I've done study-wise, and this is the most irritating answer to a question ever, but the answer is it depends. And it depends on what's going on in the volatility market. VXX, and I'm going to stick with VXX. A couple people threw the inverse versions of VXX out there for getting short. But as far as VXX goes, VXX basically gives you exposure to the front 2-month VIX futures contracts. And if you're expecting a spike in volatility, VXX is, and this is a quote from our head of research, it basically does what you want it to do when you want it to do it. I actually put this chart up, and in a different presentation, I have a version of, let me see if I can find it. I just want to show, where is that bell curve looking thing? Not that bell curve, the other bell curve. This. Since VXX came out in 2009, we've got, I want to say, close to 50-10% up moves. So, if you think that we're going to get, if you think that, and I don't, I'm talking to you guys and I'm not watching the market, so things could have completely changed. Things have changed a lot lately. But let's say a deal in Washington falls through, everybody gets worried about the market, and the S&P 500 sells off and VIX spikes. VXX is going to work. VXX is a good instrument to think of as a call option on volatility. If you buy a call option on a stock and there's some time value to that call option, you're going to experience time decay every day. If you experience time decay every day and the underlying doesn't move, you're going to lose a little bit of value every day. Well, if you expect VIX to spike and you buy VXX, and VIX doesn't move at all and the futures kind of drift lower, you're going to experience a similar type of decay. So VXX is not a good long-term hold, and I saw somebody mention that, and that's a great point. But VXX as a short-term trading vehicle to the upside, if you think you're going to get a spike in VIX in volatility between now and Friday, VXX will work fairly well, VIX futures will work fairly well, and VIX options will work fairly well also. There is a dependence on where the VIX futures are right now relative to the underlying index, how much you expect out of the index, and if you expect the curve to go inverted or not. There are lots of different factors feeding in there. I've gone through like the 50 worst days in the S&P 500 since VXX was out. Sometimes VXX worked well, sometimes the VIX futures worked better. It really was dependent on what the nature of the spike was. So not the nice absolute answer, and it just depends on what what sort of volatility spike you expect. Tony is asking, let me see, Ivy works better for swing trading or day trading on stocks. I would say that implied volatility is a multi-day factor at minimum, so it's not particularly good for day trading. Typically, and I can give you exceptions to this as well, but typically a good portion of option trading is not intraday trading. It is based on multi-day forecasts at minimum. So, if you're going to try to take implied volatility into account, that's a great, I love when I get questions for the first time, and that's the first time I've seen that one. But I think swing trading would be would be more appropriate than day trading. You can, now that we have weekly options, you can actually take into account how that we have shorter dated options contracts. So maybe just 1- and 2-day trades from very short dated implied volatility could result as well, but not day trading. So Tony's asking if VIX and the S&P 500 both move up or both move down together, how would you go about interpreting that? That is another it depends type of answer. And it really depends on what the environment is that we're in. If the S&P 500 has been up for 4 or 5 days in a row, and this is something that we've seen some this year, and VIX has been down, 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 and then VIX moves up slightly with another up day in the S&P 500. Well, it may be coming off of a very low base. You have to think about relative, what kind of environment are we in? If the S&P 500 sells off 0.5% but breaks a key support level, and there's something like an escalation of the government issues ahead of us, and you see a really big sell-off in VIX, that might be justified. So it really is a relative type of measure. I mentioned that I do a lot of financial engineering work and back testing. I've back tested those two scenarios and haven't come up with an absolute answer on that. If both the S&P 500 and VIX are up on the same day and 75% of the time, and this is a hypothetical, this is not true, and I'd seen that 75% of the time a week later the S&P 500 is sold off, I'd be telling you that. And that's the kind of things that I've looked for, and I just haven't found anything like that quite yet. So Domenico asked me I wish you had put this one out in front of everybody because this is a really good question. Can you use implied volatility to determine if options are relatively expensive to each other? Absolutely. That is actually how professional traders consider whether an option is expensive or cheap, right there. If implied volatility has moved up and and we're not coming up on an earnings release or something like that, maybe there's some rumors floating around in the market, but implied volatility is the primary way that individuals, professionals, all level of traders determine if options are expensive or cheap. Another way to think about this. If we if we take a look at Google options and they are pricing in a 20% move higher or lower in Google, and this is another hypothetical, and they're pricing in a 20% move higher or lower on earnings after tomorrow night, and the historic move has been 10%, those options are expensive relative to history. That's another way that you can think of the options. Do I know much about UVXY? Yep, UVXY is another one of those fun ETFs. I tend to spend the majority of my time paying attention to VXX just because it is a big portion of the volume, but UVXY is another one that gets a lot of attention. They all have the same sort of relationship based on whether they're leveraged or not, or have an inverse relationship. This one, it's got that leveraged relationship to VXX. It's basically going to give you 2 times the performance. It's doing it right now. I see it down about 18%, and I haven't looked at VXX yet, but I'll bet you VXX is down about 9%. Yeah, I do a weekly recap on the volatility markets, and I look at it, and that's one of the ones that I actually put on my list, and on a pretty consistent basis, it has about twice the downside or twice the upside performance of VXX. I believe that is the other one that trades weekly options as well. I think there are only 2 of them that we trade weekly options on, so you get a little bit of extra opportunity there as well. I got a question. I'm sorry, I'm not going to try to pronounce your name because I know I will get it wrong. NEJC. Is option vega more dependent on historical or implied volatility? It is 100% dependent on implied volatility. And Karsten asked, are puts and calls on the VIX related to actual VIX or VIX futures? They are related to VIX futures when you are pricing them. They settle in a value, in a calculation of the VIX index. So right now, and I've got delayed quotes in front of me, right now I've got a quote of VIX at 15 and the November, or let's say the December VIX at 1640. The December option contracts, the best underlying to value those guys at would be the 1640, not 15. Kara, you guys got to put these questions out in public because I'll answer them in public. What is the risk of volatility derivatives being more widely traded than the underlying? The tail wagging the dog. I do think that there is some activity in VXX because VXX involves positions in the VIX futures that has translated over to the VIX futures a little bit, maybe put a little bit of a damper on the front month future. We used to see a wider spread of the front month future relative to VIX, and it seems to have gotten a little bit condensed. Some people think that that is hedge funds getting short volatility, with trying to play the drift, and some people also think that it might be the proliferation of volatility derivatives. So it might be one or the other. And let's see. Wow, Cynthia, these, I mean, we could keep going forever. I had one follow-up question that I definitely wanted for clear. What extent are equity prices and option prices auto-correlated? The option market around earnings releases does a really good job of pricing in the extent of what you're going to see out of the underlying. I don't know if you would call that being autocorrelated, but because the move comes after. But I think if you adjusted those, it would be interesting to take a look at that, and I actually should adjust that sometime to see what I come up with. So, you there, Cynthia?
I'm still here, Russell.
You guys are wearing me out.
And, well, I actually wanted to bring up next month's webinar because there was such a discussion on the VIX. You're actually going to be going over VIX trading strategies on November 20th. So I'd like to invite those with more questions on the VIX to join us next month for Russell's next presentation. While the questions are still coming in, I'd like to take a brief moment, though, because there is a piece of business that I do need to go through, and that is to run a poll. Now, IB's management requires this in each event, so notice I've just opened it up on your screen over on the right-hand side. There are only 3 short questions there, and 2 are multiple choice. So I ask that you make your selection and then simply click the Submit button. Now, number 2 has an input field, but that's not where to put your questions. It's a great place for comments or suggestions for upcoming webinar topics. But if you do have any questions, hang on and put them into the chat panel. Now, there's only about let me see, about 10 seconds left in today's poll. So I ask that you go ahead, put your information in, and please click that Submit button so that we can compile the results. So thanks, everyone. Poll's about to end. Now, once it does end, you'll notice that it's covered up that chat panel that was there. But you can simply close the polling panel using the X that's included in the title bar, and then notice the chat panel is going to have a little orange character in front of it. But if you simply double-click that chat panel title bar, it will expand the chat panel where you can open and send any additional questions. So a few more questions have come in. If you've got time, Russell, if you can handle those.
Let's see. Andrew asked a question about weekly volatility versus monthly volatility. Shorter dated options, especially leading up to some sort of catalyst for equities, definitely is higher than the monthly options. A good example that we have of this is we introduced I'm trying to remember the exact I've been told to use the right name for it. The CBOE short-term volatility index with the symbol VXST. It uses the same methodology as VIX, but it determines 9-day volatility instead of 30-day volatility, and it tends to go up more. It tends to go up more when we get a spike in volatility. It did yesterday. It was up 23% when VIX was up 16%, and it tends to have lower lows when we get into calm market periods. The website, if you want to learn more about that new index, and it's not a real-time index. We only put the number out at the end of each day, but it's that website, cboe.com/VXST, and you can get the historical numbers if you want to see where if you want to see what it has done historically. It's a pretty interesting index so far, and right after we introduced it, the market started giving us some pretty interesting numbers or outputs from VXST based on the market volatility we've had. Thomas got pulled away. I'm sorry. I used to work from home, and I would have children that would pull me away. And I've actually had that happen once while I'm doing one of these webinars. The recording of the webinar, I think Cynthia is going to send something out after it gets put out there. Chris is asking, what is the relationship between the implied volatility of puts and calls? They are held together by a concept that is known as put-call parity. If the implied volatility of a call option or a put option gets or the pricing, which is basically dictates what the implied volatility is going to be, if the pricing is basically out of line with one relative to the other, an arbitrage situation will be created where, and basically this is where the high frequency guys come into play, where they can lock in a small profit trading the stock, the call, and the put all against each other. And because of that, the implied volatility of similar puts and calls tends to stay very close to each other. Again, if they get out of line with each other, the guys down the street at Citadel will push it right back in line very, very quickly. And if they don't get to it first, somebody else will. So I think I got, I do apologize. There were a lot of questions today, but
well,
I
you
think
did
I did
an
okay.
excellent job, Russell. And I'd like to jump in here for a moment too, because on IB's platform, someone was asking about historical volatility, and it's actually available in our charting package. When you go into the chart package, there is a parameters dialog box that opens up, and there's a selection there where you can actually add a sub-panel for that historical volatility. Then using your crosshairs or the cursor, you can find it out for any specific date or time period that you've been looking at the chart in. So I did want to bring that up. Now, I also, there have been several questions that have come in about, is there a recording available? And if you've missed portions of today's event or simply want to go back and review what Russell said, watch your inbox later on this afternoon, because we'll be sending out a direct link to today's recorded playback. Now, also, the slides that Russell has provided today will be available as you exit today's event. Simply watch for a separate browser window to pop up with those slides available. Now, all of these will also be posted on IB's website. Underneath the education menu, there's a webinar section where you can find our previous recordings. And all of Russell's presentations, not just today's, but for the past several years, are actually listed underneath the industry-sponsored tab. So please take a look for that, and if you happen to miss the slides as you log off today or exit today's event, the webinar notes or the slides Russell used will also be posted there today. Look, Russell still hasn't stopped.
That's a good question.
There are a bunch of questions that are coming in, but it looks like we are going to be ending or concluding today's event, because I think, Russell, these will go on forever. What I will leave, it's great that to get answers to those questions, so thank you very much, Russell. Now notice, Russell has left this on his contact information, so you can either check out his blogs, follow him on Twitter, or even email him directly. Russell is a terrific resource when it comes to options and option strategies. So thanks very much for today's presentation, Russell. I understand you've got quite a bit, or a lengthy day coming right after this as well, so lots more talking in store for you. I'd also like to remind you once again, November 20th, we're going to be going into the VIX trading strategies, so please join us, and even if you aren't able to attend live, simply register for the event, because I do send that recording link out to all who have registered. So with that, I want to also reiterate some of the comments that I'm seeing come through here. Thanks very much for your presentation, Russell. We appreciate the effort that you put into it.
I always like talking to IB clients.
Oh, and we always enjoyed listening to you. So we will have Russell back again. But that's going to conclude our event today. So thanks, everyone. And be on the lookout for the slides as you exit today's session. Very nice presentation. Thank you, Russell. But I also want to thank everyone who participated today. We know that time is valuable, and we appreciate the time that you took out of your day to join our session. So thanks, everyone. Have a great day, all. And please remember to trade smart.